Okay, so am I audible? Some problem with. Okay, so I hope you are able to see my presentation right now. And so today we start with our monthly market updates, which is of September. And like every month, we will be taking you through first the global economy, then the US economy, Indian economy, and what's happening in the Indian equity markets. And then we discuss about gold, silver, and debt as an instrument. Okay. So moving on to the presentation, we discuss about the global economy first. Now, China's. I hope all of you can see my presentation. If not, you can drop by in the Dropbox. Okay, just a minute. Yeah. Okay. So I hope the presentation is clear now. So apologies for initial disturbance. Okay, so we start with our monthly market outlook in a September. So what happened in September? We have seen the equity market is more or less stagnant at this point. It is going down, and then we see a little bit of uprise happening. And recently, we have seen there has been a softening of tone by the Donald Trump as far as the Indian trade negotiation goes. Well, let's see what the data says about what's happening in India, what's happening in the global. So our presentation will focus on global economy, then US economy, then we will move towards Indian economy, and then gradually move to the products towards the segment specifically like equity, debts, gold, silver, etc., and what you as an investor need to do at this current situation. Uh, Global economy, when we discuss about the global economy, it is been evident that China's private sector has hit dead capacity. So the graph itself says that if you see this graph, this private debt percentage of GDP, and this is China. So if you see, this is a Japan, this is Asian, this is US, this is Euro, and this is China. So if you see the China, it is unpicked right now, and it has reached is private debt as a percent of GDP is highest right now. China's banks is record margin drop as bad loan mounts. So bad loan, etc., is been increasing in China over the period of time. China criticizes manufacturers over price war as deflation fears mount. Okay, data this week expected to show prolonged bout of deflation in factory prices is running unchecked. So what's happening in China is that instead of inflation, they are having a deflationary trend right now, which is also not likely a favorable condition for the economy. China's industrial capex sign of slowing down, transition of manufacturing in China. So if you see that the data here, you will see that there has been a transition of manufacturing in China. Share of year on year change in manufacturing June to July. So agriculture processing is increasing in China, automobiles, general equipment, manufacturing, and we are seeing that pharma, electrical equipments and chemical, these are all slowing down. Global manufacturing PMI improved slightly. So this data itself shows that global manufacturing is improving slightly. Global economy is set for slowdown in CY 2025. So this is the projection. Okay, this is actual happening in 2024. So if you see the world output, real GDP annual percentage share is 3.3%. Now this year is expected to be around 3, and in 2026 it's 3.1. So advanced economics will slow down. United States will slow down. Euro have a slight edge. And if you see the India, which will have a near stagnant zone itself, okay, China will slow down drastically. So this is the real GDP percentage wise and is a IMF data source. Okay, so this is the GDP of world in 2024, and this is the expected GDP in 25 and 26. So if you see the bearing India, which is will nearby remain same, most of the countries will go down and down. Okay, so most of the countries, so this is Middle East and Central Asia will increase. Sub-Saharan will also increase a little bit, but if you see this advanced economics, basically driven by the US, it will go down, and as well as China will also go down. Inconsistent GDP growth. So this is 2025 Q1 and this is 2025 Q2. So if you see the Q2 2025, which is in US, we have seen a rise, but in QY it has been down. So that's why I'm saying that there's an inconsistent GDP growth happening over the quarter. Some quarter it is rising, some quarter it is going down. Rates and market have moved in opposite directions. So if you see, this is the Dow Jones Industrial Index, Nifty, Korea Index, Shanghai Index, Nikkei Index. So this is the YTD return of the index performance. This is the central bank easing or hiking the interest rate. So in Dow Jones Industrial Index, the central bank eases the interest rate. 30-year bond yields is 4.78, and 30-year bond yield after easing it was 4.93. Okay, so you can see this, the market and rates are moved in a quite opposite directions. That's what we are mentioning out here. So I'm not, this data I have only showed you, I'm not judging what is right and what is wrong. So what data in a global economy says that China total GDP is slowing down. China's private debt to GDP is at all-time high now, and also China's manufacturing shift there has been showing gradually towards a little bit towards agricultural sectors, and they were predominantly towards electronics and other pharma, and they're moving on to those sectors. As well as the China's debt is increasing, their banking sector, a lot of NPAs are coming up currently. As far as the global GDP is concerned, we have seen that in year 2024, from 25 to 26, the GDP of the global will remain more or less stagnant. With advanced countries, their GDP will go down. China will also go down, developing, but India will remain more or less stagnant. So that's what happening in the GDP front. So that is what happening globally, and GDP growth has been quite inconsistent. Like some quarter it is moving high for some country, and some quarter is going down. So that's what happening in globally. Okay, so let's see what happening in the US. US has started the tariff war. We all know tariff imposed on countries under Trump reciprocal regime as of August 6, 2025. So this is the tariff, and I have mentioned the percentage of tariff as far as the graph and color mentioned out here. So you see this black color, this is the highest tariff they have incurred. You see the Brazil, India, China, and some other countries, they have imposed the highest tariff. US economy rebound in second quarter in 2025. That's what I said, that their GDP growth has happened in 2025. So this is the Q1 2025. This is the Q2 2025. Their economy has rebound this year. And this is predominantly not because of tariff. Tariff impact will actually be shown in third quarter and fourth quarter, because they have been quite on shuffling between interest rate, tariff rates here and there. So, okay. US GDP growth bounces back as import plummet. So why the US GDP growth bounces back? Because the import has reduced its percentage point contribution to US GDP growth in Q2 2025. So if you see, the real GDP growth is 3.3, personal consumption, this is private expenditure, government spending, export was less, and imports was there increasing. So that is the reason the GDP has gone high, because obviously, as they import more and more, because they do not have now today. If you see, the US hardly manufacture anything; they assemble all product from the globally, and then they give it back to their customers in the US. So eventually, the tariff, which we are not sure till now, Okay, so because Trump has been going on and off, sometime he incur tariff 10, 15, 20, 50%, and then he in the next day itself he reduces back. So we are not sure about his policy. Is actually playing the game of threatening people so that they come in line with what he's expecting to get the best out of those countries production and the market. So that's what he's playing around. Okay, so that's what he's doing. So the import has plummeted. That's why the GDP has gone high in the second quarter, but this is not sustainable. Now, if I move ahead, now big seven tech led the investment charge. So if you see the seven big company capital expenditure of the big seven tech companies versus the rest. So this is the red black line is the rest of the companies in US, and this is the red line is the tech seven top seven companies in the US. So if you see the investment of the top seven companies, obviously Donald Trump has told them that you need to invest big in America. So, last 10, 15 days back, he have called all of them for a dinner, and and he assured and he get somehow kind of assurity from all of them to invest huge amount in US. So these big seven companies, they have been investing hugely in US. And if you see the data, all the seven companies investment together with all the rest of the companies. So US have got huge amount of listed company, which is like moving to lakhs. Now, if you see the listed company in India is like 3-4 thousand approximately. So you can imagine the seven companies total investment vis-a-vis the all total company investment is more or less same. So that's why the Trump has been doing muscle flexing and telling them to invest. U.S. government spending is equal to 44% of his economy. U.S. government expenditure as a percentage of GDP. So this is the U.S. government expenditure COVID, and 2033 US government spending near 50% of GDP. So this is the US government spending right now, as we speak. Okay, so the amount is huge, and that is one of the reasons Trump has been there to cut all the subsidies. He wants to cut all the foreign investments via your military and other methods. And so, because if you see the loan situation of US is also worst, so that is the reason he wants to cut short all the government expenditure, because 50% of US government expenditure percentage of GDP is huge, and he's been trying hard to get more and more investment into his company, which is evident from the last slides. US bankruptcy filing exceed 2020 level. So that's what I'm saying. So a lot of companies in US are getting bankrupt. Okay, so you have to delve through July, rest of the year. So this is the US bankruptcy data. Okay, so if you see this data in 446 right now till July, and you will find the most of the bearing this to year when the subprime crisis happened. See, a lot of companies are getting bankrupt right now. So that's what happening in US. Unemployment climbing at the starting job. So this is the unemployment rate which is rising higher in US federal deficit and debt has remained elevated. So this is the US national debt, so 37 trillion. Okay, I know I forgot to count this total. This is a huge debts that US is having right now. And this is the US fiscal deficit also. Okay, so that's the US data point. Tariff burden to shift to the US consumer. Now, what happened is that now, if Trump has imposed tariff, and what actually happened, because when you impose tariff, it actually moved to the consumers. Preliminary estimates is that more than half of the tariff costs have been absorbed by the US business so far, but this share may decline to 8% of the name, saying a consumer and foreign exporter gradually absorb more of the cost. Obviously, when you impose tariff, the cost of the import goes high. Now, if the cost of the import goes high, who will actually bear? The consumer. And as a result, US inflation is bound to rise in the days to come. So moving on, foreigners own a lot of assets. So this is what in US equity, 20% of the total equity is owned by foreigners. In treasury, 30% of the total treasury is owned by foreigners. And corporate credit, 30% of the total corporate credit is owned by the foreigners. DY index is below 100. US targeting India unfairly. Now, a lot of people have been saying that US has been imposing higher tariff to India. I presumably say that it has nothing to do with Russia and the Ukraine war. It is primarily US want India to take more and more, material from US. They want India to buy oil from the US. They want India to open up their agriculture and other fields. So there is an indirect way of pushing India, the punishing India, the muscle flexing by the term. So that's what they're doing. So if you see the data in coal, uh, you know, the fossil fuel import by countries from Russia, China import maximum from coal, crude oil China maximum, pipeline gas European Union maximum, LNG European Union, oil product Turkey maximum. So you can't find India in any other. European Union has been maximum importer of pipeline gas from the Russia. So that's what the data is saying. So that's what is happening in the US. Okay, so if I see the US data very clearly, it tells us that there has been a high debts in US, which has been there in all my slides in last 6 7 months. Secondly, US the tariff that US is imposing is very unfair. The data itself shows that most of the countries, even European Union, has been importing high amount from Russia. So the tariff because of Russia-Ukraine war is not, because US wants India to buy more from them and open up their Indian market. Second, we have seen that in US, we have seen the unemployment rate is increasing. Foreigners are having a lot of assets in India, US stock market and all these things. And then we have tariff burden will shift to the US consumer of definitely. Unemployment rate is increasing. I've seen a lot of companies are getting bankrupt in US. And then the US government expenditure is nearly 54% of the total economy. Big tech investments companies are investing in US huge than the rest of the companies. So basically, like the big seven tech companies are driving the US economy. And in these situations, the last quarter, Q2 quarter of the US, the GDP growth has increased because why the import has plummeted in US. So that's what the reason. So all this quarter, all this says that US is a very delicate shape. The only biggest factor which I consider out here is the because of the tariff, the inflation number is going to raise in days to come. With high debts happening in US, the data which shows here, with the and if the inflation raises higher, then they have to increase the interest rate, and then this debt will go much higher also. That is a vicious cycle. And if I don't know what Trump is there in his mind, and that is the reason uh, why I say that the situation in US is not looking very attractive. Okay, only the seven big companies are investing, so that's what is happening. So if I have discussed about the US economy, I discuss about the global economy. Global economy, primarily we discuss about the China. The situation is China is also not very great. And that is the reason I showed in the very beginning that the GDP growth forecast of 2025 and 2026, US is a slow growth and China is decreasing. US is also decreasing GDP growth rate wise, and China is also decreasing, and India will remain more or less stagnant. Very nominal, impact will happen of the US 50% tariff, but India will remain more or less stagnant at 6.5%. Okay. Now let's get back to the Indian economy. So what's happening in Indian economy in the month of August? Indian economy grew at 7.8% in Q1. So this is the data beating estimates. So the GDP growth in Q1 was 7.8%. Remember, we discussed about China, we discussed about US, which are way below than what they are in India. Factory output surged to a 17-week high. India services PMI hits 15-month high. Indian railway fleet earning touches highest ever 14,000 crore in the month of August. India posts strong, robust 7.8% GDP growth. I told you already in FY 2026. 6 month rolling government capex is a record high. I just quickly move. GDP growth is real. So this is the GDP growth differentiator. I told you that GDP growth from 1990 to 2024, which is times 12.2 times growth. Okay, export growth, air travel growth, two-wheeler production. So if you see the all this number, it has grown multiple times. Okay, so that's what we are mentioning. India's rising role in the global economy. So this is the contribution of global GDP growth, India's share in the global GDP growth. So this is the Indian share in the global GDP growth, and this is the contribution to the overall GDP growth. So if you see the India's contribution in the global GDP growth in 2025 to 2030 data, which is huge. So that is the reason India has become a prominent player now, and that is one of the reasons why in the last 7 days Trump has come back to India and they agreed for a discussion over the tariffs things beside other geopolitical happenings. So India is fiscally prudent. So if you see the data out here with other countries, so India household, corporate, governments debt. We are talking about the debts. So if you see the debts of India is 176%. This is Q4, 24% of GDP. And now if you see the other countries, okay, so this is huge. You see the debt to GDP ratio. This is overall. This is Australia, Brazil, China, France, and India. So if you see the India, it is much, much lesser than the other countries. Market is re-rating India. First major sovereign rating upgrade from India in 18 years. So this is that there has been a rating upgrade from India. Our earlier it was triple B minus. Now we are triple B. Short-term rating has also improved, and trans and convertibility assessment has also improved. So we are having a better sovereign rating in India, and that happened after 18 years. Tomorrow's states will be as big as yesterday's India. So if you see what will each state become 1 trillion economy, assuming 8% CAGR, India has been clocking growth rate of 6 to 7% in recent year. So this is the year when we have mentioned out here, and then you can see that 1 trillion economy each state. So when I mention like Rajasthan in 2046 will be 1 trillion. Okay, the nearest, the first state will happen is at Maharashtra, which is 2035. Okay, so that's what the data has been given out here itself. So when will each state become 1 trillion economy? No, we need to invest for future, like India for India and the world. India for India, built for India, semiconductor, robotics, nuclear fusion, industrial capacity. This is a nascent capacity. We have a stronger capacity like renewables, cloud service, travel and tourism, and urban constructions. And this is what we have mentioned out here. This is a sector we are slowly building up, and this is a sector we already have a strong capabilities. So that's what I mentioned. Like we are nearly about $4 trillion economy, and from $5 trillion to $35 trillion, and below are the sectors. This is the sectors which will actually add 10 to $12 trillion in growth. So what I mentioned out here is that these are the sectors where India will be rapidly growing. And if you want to make major investments or make your value move, aerospace and defense, biopharma, electric vehicles, semiconductor, nuclear fusion, industrial electronics. These are sectors which will have maximum growth in the years to come. So if you are investing any of these sectors, obviously the company has to be better, the research has to be well off. Then this sector is going to add 10 to 12 trillion in next 30 years, and that is huge. Deficit in rain capital, excess in desert state. So this is the India has received 2% more rainfall than normal so far, but extreme standout Meghalaya faces a 43% deficit, while Rajasthan and Ladakh report surpluses. So this is a strange data. Okay, so the first time we are seeing that in Rajasthan and Ladakh we have huge surplus rain, whereas the Meghalaya, where we used to have a huge rainfall, it is having a dry kind of thing. So that's the deficiency here, and that's the surplus out data out here. Water reservoir level across region. So this is the region what we have given. This is last year dark one, and this is the present one. Urban demand for FMCG products saw sign of improvement. I just don't want to stay here. I just show the data itself, like FY25. You can see this is the rural, this is the urban FMCG product. Urban demand has been increasing. Okay, this is the increasing shine that they have shown out here. US dollar 90 billion consumption stimuli over FY26 28 estimates. So this is the estimates of huge stimulus being given by the government in days to come. Okay. The GST rationalization could lead to a 2% of fiscal slippage for the center in FY26. So we know that the last 10-15 days back, there has been a GST rationalization, and that can actually lead to 2% of fiscal slippage for the center in FY26, but it makes things smoother from the business point of view. Capacity utilization remained at robust level. Oil prices deep at OPEC, output rises. So we have seen this is a good news for India because oil prices has come down. We are a large deficit with China. Now, this is an important data. Among all the positive which we have shown earlier, now we are a large deficit with Indian annual trade deficit with China. So the what that actually says that there has been a huge mismatch in import and export with China. That India need to fix up with this. Okay, this is that's what I'm saying. Export minus import. So that is the data which we are showing, and we have a large trade deficit. So that see the numbers out here itself. So that is the thing which India needs to take care of to reduce this large deficit with China. GST collection lowers in July 25 than estimated normal GDP growth 10% of FY26. So GST collection was a bit lower in July. Weak job creation in IT sector recent quarters. IT sector job creation is lesser because obviously we know what's happening in US and a lot of contract getting cancelled because of tariff threats and all those things. New Trump tariff on Indian goods are among highest in Asia. So I told you earlier also in India, the secondary tariff, because of the secondary tariff, is the highest tariff in India that they have imposed. So this is the actual tariff, and this is India, which you can see, and this is the secondary tariff that they have. US tariff sector impact. Auto component, we have a negative impact. Capital good, negative impact. Building, EMS, textile, we have a negative impact. Okay, so this is the negative impact. If you see the textile, Indian tariff of 50% is at disadvantage to competing countries such as Bangladesh, Sri Lanka, Vietnam, Pakistan, Indonesia, and Cambodia. Untimely heat as summer spring orders are placed around this time as a retailer. Indian players exposure to US range to 20 to 60% of their revenue. So normally in textile, what happened that 20 to 65% of the revenue comes from the US, and with 50% of tariff, India, this particular textile sector is at a competitive disadvantage against Bangladesh, Pakistan, Sri Lanka, and Vietnam. And this is the sector which has been impacted by the tariff, and obviously the stock price of this sector has impacted also. Chemicals, aqua, and basic industries. Pharma is uncertain because they have removed pharma from the tariff sector. Oil as gas has also removed because India and also taking major oil from the Russia, so it doesn't have any impact. IT has been a positive, no direct impact. Second order impact for minor depreciation. So that's what is IAS US tariff impact is happening. Diversification to new market necessary to increase export. Now, what happened that because of the US imposing tariff, one good thing will happen that India is trying to capture other market. Now, off late in last 15 days, we have witnessed that India has been driving the even the ministry, the foreign ministry has been quite aggressive in getting new market for the textile sector, and there have been talks with the European Union for getting no new trade negotiations, new trade contracts, and new tech partners accordingly. So this will actually help India over the period of time and make them sure that they cannot depend on one country for over dependency. And this will actually make Indian product available variety of places across the globe in days to come. And eventually this will actually impact America also because they have been taking product from India which predominantly is cheaper than other Asian countries or European countries. And once the tariff thing neutralizes, I presume that in 6, 8, 9 months from now, the tariff thing neutralizes. Even the Trump will not be there throughout his life as a US. So if this thing normalizes, then India knows that they cannot rely fully on US, and they will have much broader market by the time things got settled down. So in a long run, I think this is one of the things which has happened is good. India US economic flow, who earns more? So that's the thing. India earns from US is 196 billion. US earn from India is 199 billion. The US is plus 3 billion. So that's the sector which I have given. And here you see the students. US earn more. Digital IP investment, US earn more. Defense and aerospace earn more. India is exactly earning more from goods, services, and company revenues. Okay, so that's what I have shown you a clear data. While India runs a clear surplus of goods and services, dominance of US companies operating in India is significant in keeping the balance overall flat. Okay, so that's fine. So when I see the digital and IPN investment, whatever things we are using like WhatsApp, Facebook, whatever, Google and everything, so those are an US company, and those earning are also, they are earning from India. So if you see the overall, what Trump is saying is wrong, because US is also still surplus at this current situation also. Okay, why do America big techs earn from India? You see, this is the Apple earning, Amazon, Google, Microsoft, and Meta. This is the Facebook. That's what they are earning from. US tariff. I cannot remind Americans about this enough. You had revolution because you didn't want to pay tariff on tea. Which state elections results into populism? Will state election result populism? So there are 6 states to undergo election in May 26. These states represent 23, 16, 17% of total state expenditure, subsidies, and capex respectively. So we have these 6 states coming up: West Bengal, Kerala, Tamil Nadu, Puducherry, and Bihar. Now, these 6 states will have total expenditure and represent 23% of total sales expenditure, subsidies, and capex respectively. So there will be some impact, and likewise, the election in India will keep on happening, like 26, 27, 28, like 29. We have a big election of General Assembly, uh, general elections in 29. So this thing will keep on happening. Populist measures will keep on coming and going. But eventually, the steps which Indian government has taken, like GST rationalization and all things, will actually counter all those populism measures. And in India, to be on a power, you need to have this populist measure. You cannot be rigid enough. This thing, then it will not be in power in next couple of years from now. So this thing we have to take as a needle, or what you can say Achilles heel kind of thing. But this will remain. We need to see the broader picture and see what happening from here on. So that's what happening in India. So if I summarize what is happening in India, we have seen most of the data are positive as far as the GDP goes, industrial production goes, and most of the data are positive. Monsoon is also positive, but there are slightly a different phenomena coming up, like Rajasthan having a surplus, Ladakh having a surplus monsoon, and having a Meghalaya, which is a deficit monsoon. And among all this data point, we have been seen the data of India and US tariff also, despite US saying that they will impose, US earns more than India. Uh, well, that's a data point from here itself. And one important data which we have said, that the election is coming up in next couple of months from now. So that will have a little bit of populism mechanism from the government. But I don't think with the overall space that we are moving into will have a much impact accordingly. So there have been couple of sectors which have been negatively impacted, but as I mentioned earlier, eventually it will ease down as we move ahead from here. Okay, so now we discuss about the US economy, we discuss about the global economy, we have shown you the data of the Indian economy also. Now let's see what happening in the Indian equity market. Now, as far whether the valuation is high, cheap, average, or ready to investment at this point of time. So, market cap to GDP ratio is at all-time high is 122%. But this data I always mention, if you see the last 20 years, this data will deceptive. But if you see the last data in the last 5 6 years, this average will come down. Okay, so last 20-year average is 87, but if you see the average of last 6 7 years, this average will be hovering somewhere around 115 to 120. So as we move up, as we move ahead, we have been mentioning here from $5 trillion economy to $35 trillion economy in next 30 years. The huge amount of investments will come. This thing. So this market cap to GDP will remain at this elevated level. So don't go by this figure. If you see the 20 years average, okay. Indian share in global market is easiest from September 24 pickup, but it is still higher than this average, historical average. Now let's see the valuation wise. Market is trading at a historical valuation. So if you see the Nifty PE, it's more or less stagnant. It's more or less not very. We have only 9% premium to historical average. Again, the historical average is 20 years. Like now, if you see the historical average for the last 7 8 years, we are actually and at a discounted phase. So what I mentioned, that large cap, Obviously, if you're investing in a large cap, I'm talking about the cap as a whole, not as a company, but large cap look attractive if you know the company, if you have done your fundamental research, then large cap looks attractive. If you see the mid cap and the small cap, mid cap is 10% premium and small cap is 40% premium. This is the small cap index. Now, if you see the last 20 years, from April 27, so April 17, okay. So this one is April 17. So last 8 years, we have an average of 17.8. Now it is moving around in 25. Now, if you see the last, 3 to 4 years, this average will go high. And small cap, trust me, small cap, this P ratio will always remain high. Now, if you see a historical average, if you compare with the historical average of 10 years and 15 years, you will be at you will think that market is costlier. But small cap in India will always be higher, because from India to moving from 5 trillion to 35 trillion, this sector will have to become and contribute. A lot of companies are listed, getting listed, and they are aggressively performing. So this, I presume that if you have a longer duration in mind, like 10 years and 12 years kind of thing, go with a large cap, go with a small cap segment, because that's where you can make really good money. But not for a very short duration, like 6 months, 1 year, or 2 year. Don't go, because even if for the shorter duration, the average of 5 years PE is higher. Okay. And as far as the mid cap goes, which is absolutely looking attractive, the 10% premium in mid cap is absolutely priced at. So this is looking very, very, I think, at a discounted level. Don't go with the 10 years or 7 years average. I always look for the 3 to 4 years average, because that's what the market is moving up. So small cap, yes, shorter duration, don't go. But if you're 9, 10 years, I strongly suggest go with a small cap with a good company, fundamentally good company. Mid cap and large cap today look very attractive. Okay, provided you pick up a right company to invest into. And FY26 results a little ahead of expectations. So this is the FY26 results, like automobiles, capital goods, which I've mentioned. Profit after tax, this is the numbers. This is the year-on-year growth. This is the actual growth happening. So if you see the segment I have mentioned out here, automobiles, capital goods, cement, chemicals, and this is a sector, the data itself shows you. Okay. So this is the year-on-year growth, if you can see the data point out here. Moving quickly, top line sales slows, earning driven by margin and leverage. Top line growth for Nifty 50 index, exponential. So this is the top line growth for Nifty 50. This is the most of the earnings is driven by margin and leverage. PAT GDP trajectory, it is maintained. Indian return profile still dominates other key markets. So if you see the Indian market ROE percentage, it is way ahead than most of the market of other developing countries. Indian return profile still dominate other key markets. So that's what I'm saying. Return on equity. And when I say the US, now, as I mentioned, the top 7 US company contribute most of their total growth. So if you remove those top 7 companies, then US ROE, this will go down. Okay. So, but as India, it is a holistical movement. It's not predominantly driven by the top 3 or 4 companies kind of thing. Indian ROE differentiation over emerging market expected to be at average level of 2% in CY26. I just quickly move on. Indian valuation premium to emerging market close to long-term average. Indian earnings differentiation emerging market. I just quickly move. I mentioned DII. This is important data. DII monthly flow in equity continue to be robust. This is domestic investor despite having so much of volatility. We have seen in August massive number of inflow from domestic investors. Capital market supply remains strong. Also, the capital market supplies remain strong. FII was net seller again in the month of August. So if you see the FII data, they have been consistently selling from the last 2024 onwards. Okay, so this year predominantly they have been selling a lot, but if you see the DII, they have been consistently buying. So that is the reason why market has not gone much deeper. And trust me when I say this, even if the FII sells lot, we DII will continue to buy, because there's a huge amount of money is coming from the provident fund. Most of you, I mentioned this last time also, Government provident fund, there's been mandated that you have to go certain percentage towards equity. Now government is considering to increase that level to 13 to 14%. Now imagine if that thing happened, that can be a huge. Forget about what you as an investor invest via DMAT, what MF mutual fund SIPs and insurance SIPs are coming up. But provident fund investment, gratuity investment into the equities are huge. Okay, and that's come every month automatically, and that is the reason that DII flow has been consistently very high, and it has actually negate that FII outflow from India, and that is why market has not gone down. So people saying that market will go down, I don't see the data happening because of the strong DII inflow happening. So positioning based of active weight varies significantly across FI domestic mutual fund retail investors. So this is the data. See the materials. I given you the segment and where the inflows are happening and outflows are happening. That's I'm showing the data. If I FPI holding an equity further, so that's the reason. See, if I have been consistently selling and now they are only 15.8% holder. Remember a time when FI used to hold near about 20% on Indian equity. Now they're at like 15.8% of Indian equity. And even if they have been selling, the market has not gone down deeper. Ratio of MSCI emerging markets and piece US in 94. I just quickly move. Many stock have delivered return. Many stock are trading at expensive valuation. Now that's what I say that when I talk about large cap, small cap, and mid cap, you need to do as a sector I mentioned. But if you look up the stock specific, then you do your own fundamental research. Don't go for the company which are very expensive valuation right now. There are company available in the small cap, large cap, and mid cap space which are attractive valuation right now. Pick up those companies and invest because as a whole, the sector large and mid looks attractive. Okay. Moderate return expectation significantly. Be ready for volatility like this will continues to even happen throughout your lifetime. We mentioned that overweight already not weight underweight, but small cap we are not very underweight. But yes, if you are having a shorter duration, then you can actually look for a small cap. Don't go for a small cap. But if you have a 7 8 years of duration, I will strongly recommend instead of going to the mid and large, go with a small cap investment. You make a massive amount of money as India will move towards, from 5 trillion, $4 trillion economy to maybe 20, 10, 15, 20, $30 trillion economy in next 20, 30 years. So that's what in equity investment opportunity I mentioned. I will not mention a company's name as of now because that's prohibited. So if you want to know about individual companies' performance suggestions, you can refer to me WhatsApp. Most of you know my WhatsApp number. I will get back to you in that thing. But holistically, we have been mentioning about what's happening or the overall economy as such. So debt market outlook. This is the global currency and currency performance over the last month. So India has a little depreciation, and then we have US inflation broadly stable, but this data will not remain because of the tariff impact happening in days to come. Fed future pricing 3 to 4 cuts by March 26. I can say if the inflation goes high. 30-year yields movement gradually. So this is the 30-year yield movement. See the India 30-year sovereign yields. Uh, okay, so change in 30 years. So this is the movement happening in the globally as far as the yields sector goes. Indian CPI inflation moderates. India inflation even moderates level very high. So this is moderately low, not high, moderately low, which way is between the benchmark of 2 to 6% level. So see this data core CPI inflation, okay. So which is way in between a 2 to 6% level. Inflation likely to lower than the RBI estimate. So this is the data. So which we are expecting the inflation to be lower, and that can give more breather space for the RBI to cut rates. uh, Enough liquidity remain, systematic liquidity remain in surplus. I mean, RBI active demand, RBI measures since 20 support growth. So they have cut policy 100 basis point. CRR they have cut, reduced significant durable liquidity to OMO. I mentioned this couple of months back that they will do this thing. Financial liquidity, final liquidity coverage ratio guideline tweaked, resulting in 6% excess liquidity for the bank. So ineffective transmission of rates in capital market. So that's what is there. transmission of rates as far as the RBI goes, it has been ineffective across all different bond paper. So that's what I mentioned out here. Bond market sees stops yields, annual default rates for cooperatives were a 17-year low. So that's a very good point. Now remember this data point with the Chinese data point, which I've shown in the beginning of our slides. They are having a huge corporate default rates going on, and where you see the India, the default rates is coming down. Okay, so as far as the debt market investment opportunity goes, we can expect the inflation to be coming down as we are projecting. So you can go with a long duration paper right now. And if you're willing to invest in debt as an instrument, so go with a long duration bond paper, you can get the advantage of interest rate cut if it happens in the next 3 to 6 months from now itself. Gold, well, most favored asset class of all of you. See, the gold has been a top performer in last year. This year also, it has been outperformed. The reason because most of the developing nations, Russia, India, China, they have been buying gold like anything. Foreign central bank hold more gold than treasuries. So this is the thing, gold holding. Okay, and gold share is rising in international reserve. So that's what I'm saying. So gold share is rising. So people more countries are accumulating gold. Central bank gold accumulation 2025. So this is the Poland, this is Azerbaijan. See the most China, Turkey. So most of the companies, most of the countries, they're accumulating gold like anything. Why this is happening? Because that again, that's the geopolitical. Just give us kind of glimpse into that, because you know what is happening in the BRIC nation as far as the currency goes, what the future holds, because you know about the dollar dominance and all the disputes happening between dollar and BRICS nation and all. So most of the countries are accumulating gold. Gold is the only currency which is acceptable across the globe at the same rates. Okay, so that is the reason that gold, the country will have more gold reserve, it is beneficial those countries. So that's why they're accumulating gold, and as a result, it's bump up the prices. Investor pile into gold and silver backed ETF. So same thing happened with silver also. Silver has an added advantage because it has an industrial usage also. So we can see the silver moving up for although from here, but although I feel that there can be a slight correction in silver in days to come. But if you are having 2 to 3 years duration in mind, go and instead of gold, because gold has already performed in last 2 years. Last year 27%, this year 30% they have grown. So silver I think is much better attractive opportunity right now than gold. Gold, however, as I mentioned, gold have valuation are very stretched. So that's why gold is cheap, energy is expensive. That time, now it is different. Manufacturing gold, so people are claiming that they can manufacture gold, but I don't think so that's going to happen. India moved expanding pension investment to include gold ETF. Okay, so that's, you see, India moved expanding pension investment, sorry, to gold ETF also. So if this thing happens, then gold prices also go a little bit higher from all. Silver since 1980. See, this is the silver movement here. Unlike gold, silver has not moved high radically. So there has been a chance for silver to grow much from here itself. So the central bank has started buying silver. So see, this is the data. So that's why I mentioned that silver as an asset class, I feel that it can be a very attractive asset class from all of you. Okay, so start accumulating silver a little bit from now onwards, because so the central bank has started accumulating silver. This is the central bank of different countries. They have started accumulating silvers as of now. So that's all from the gold and silver point of view. So my preference will be a silver slightly right now. And if you see the holistic as an investment, large cap and mid cap, if you pick up a right stocks, go with it, go for investments. Small cap, yes. If you have a longer duration, go kind of small cap. From gold and silver, pick up the silver, which I look little attractive propositions from now. And as a debt instrument, go with a higher duration bond, because in next 3 to 6 months there can be interest rate cut, which you can take benefit out of it. So couple of data points from here. Domestic index performances. This is the domestic index performances across all segment. And small cap, obviously, you see the last 1 year, Nifty 50, next 50, mid cap, and all the things. This performance are mentioned out here. And sectoral index performance I have also mentioned. If you see the last 1 year data point, most of these things are in the negative. Highest negative, you can see the metal is in the highest, energy is in the decrease point of view. So those are, where is the defense? Where is the defense? Defense is there itself. So defense is not there anyway. So these are the sectoral performances. So pick up the sector which has been drastically brought down by those things. Okay. So if you are having a long duration, pick up a sector which has been down from its stock from a much higher level. Forget about the trade barriers and all. These trade things will happen for 1 or 2 or 3 or 4 years. So if your investment is a longer duration, pick up sector which has been badly beaten up, not perform in the last 3 to 4 years, and pick up the companies which are well poised, fundamentally strong in this particular sector. Global index performance. Again, I told you this is the different companies. Individually, I've shown you when I was showing you the data point earlier itself. Shanghai Corporate Index, like the China, has grown tremendously in last 1 year. So if you see the last 5 year data of China, it has not grown. China has grown maximum in the last 1 year itself. So those of people who have invested in China through us in a greater China funds, we are available. So they have already made a great amount of money out there. So this is the driver effect of GST, disposable income. So couple of data point I've shown you that can be effect of GST kind of thing, like food, personal care is positive. Cigarette, it is majority of food product now move to 5% GST. For cigarettes, this older GST rate including sales to continue until loan and interest payments obligation and provision is discharged. GST 40%. So this will be a negative kind of thing. Consumer discretionary, that will be positive, and couple of sector apparels will be negative. So I have mentioned sector-wise positive and negative factor for the GST itself, but the price will eventually factor in out all those things as we days progress. Okay. So these are the couple of impact sector. I just quickly move on, not getting into deeper into individual sector, because eventually you should not go only by the GST cut. Go by what exactly company fundamental stands for. Top 10% of US stocks now control 76% of the market. So I told you the ROE US percentage you've seen the highest in US. That's what I'm saying. Top 10% of US stocks holds 76% of the market. So that's what is happening. If you remove those top 7-10% company in US, the US is down. Okay, way below even the emerging, lot of other struggling emerging countries also. Nvidia near Japan entire market cap. So that's an interesting data point. Who made the market? Like, so foreign portfolio investor, domestic individual investor, net, BSE Sensex. This is the data point from here itself. A big look at net inflow from each category of participants. Okay, so in 2025, foreign investor are down, mostly are from domestic institutional investor. And when I say this domestic institutional investor, it is not individual investor like your you're investing on DMAT. This is basically from the government. I told you about the PF, I told you the gratuity, and this is the segment which actually investing a lot. And when I say the investing a lot, this will remain. Okay, so this will remain. FY26 performance snapshot of Nifty. This is a different segment altogether. I have showed you earlier also. The global brilliant breakdown, nothing to show out here. Important snapshot. It's okay. So most of thing we have already covered. Bank deposit but the mutual trend of the US versus India. So this is interesting data. Like if you see the bank deposit versus mutual fund trend of US versus India, US bank deposit versus mutual fund. So if you see that this data point, mutual fund AUM as percentage of bank deposit 118%. Okay, Indian bank deposit versus mutual fund AY. See, this is the data which I'm talking about. Bank deposit USD billion, mutual fund USD billion. So see the data point. In India, bank deposit, mutual fund. Okay. In US, bank deposit, mutual fund. So mutual fund is higher. Here you see the huge amount of money still going to the bank. Okay. Steady increase in share of equity in household asset over the FI, this thing, list of narrative. So I just move on for this thing. So mostly I have covered all the data point today. So on a summarizing, what I mentioned today is like the sector which are attractive right now is definitely small cap for me. If you have a longer duration, look for the companies which are fundamentally strong. Don't go for the GST cut and its impact. Instead, look for the fundamentally poised company. I have showed you the segment which are having huge depth in last 2 to 3 months as far as the fall is concerned. Pick up those segment, pick up the good company in the particular segment and go for the investments. I have showed you the sector which has been attractive right now. You can pick up those stock itself. Globally, situations doesn't look good. US also is struggling, but data from the India looks extremely positive. Okay, so if you have any query, drop by in my inbox. I will get back to you personally. Do consider watching this every month at a second Saturday at around 4 to 5 p.m. We take normally market updates. For any question of yours, I will get back to you in my WhatsApp. So do drop by your query in my WhatsApp. I will get back personally to all of you. Thank you very much. Thanks.